Hello students, welcome back. Let's continue the learning of the chapter Government Budget, which we began in the last video, and here we begin. In the last video, we tried covering the definition of government budget and the objectives of the government budget. After covering all these, today's topic in hand is the component of government budget. So let's proceed. The budget is broadly divided into two main accounts, the revenue budget as well as the capital budget. So let's talk about the revenue budget first. And the word revenue, it's not a new term for all of you. How and why? Because revenue means which has no impact on assets and liabilities, right? So this is the definition. It deals with all the expenditures and incomes which do not impact the government's assets or liabilities. So they do not impact, right? And revenue budget, again, it would have all the revenue items. On one side, it would have revenue receipts, and the other side, it would have revenue expenditures. So when we talk about revenue receipts, first understand receiving some money. It means there is some other transaction is the reduction in the asset, right? So, but because it is revenue in nature, so how do you define it in terms of assets and liabilities? It's very, very important. It neither creates liabilities nor reduces the assets. Means whenever we are talking about receipts, right? So assets are not reduced, liabilities are not increased. So this is the definition of. When this does not happen, this is the definition of revenue receipts. Okay. Now, revenue receipts primarily talk about the tax and non-tax revenues. Okay. And when we talk about tax revenues, we have primarily two types, the direct tax and indirect tax. Little before also I talked about the progressive taxation means it is the direct tax wherein the liability and the burden falls on the same person. He cannot shift his tax liability on some other person. Direct means the income tax, wealth tax, gift tax, all these corporate tax, these all taxes are, of such a nature that whosoever is earning, that person only is paying. So the dent on the pocket is felt here in direct tax, right? And it is generally progressive in nature. That was made clear in the last video also, that whenever the taxation is based on the ability to pay, higher earning people when are paying higher taxes, it means it is progressive in nature. But when the same level of tax is paid by all, a rich or a poor person, so that becomes a regressive tax, which is not based on the ability to pay. And the example of regressive taxation is indirect taxes. Right? For example, take a packet of milk from the market. So if that packet is taken up by a rickshaw puller or by the CEO of a company, right? Both are giving the same value of taxation. And for a rickshaw puller, those 2 rupees would also be a matter, but maybe for CEO, it does not matter at all. So when it is not based on the ability to pay, this is regressive in nature, or we call it proportional, right? And this is indirect. And when I say indirect, indirect means where there is a scope of shifting the tax burden to somebody else. For example, you watch a movie in the theater, right? So what do? You, along with the ticket amount, you're paying taxes, right? That tax is collected by the cinema owner, and that is paid by the cinema owner. But who actually paid it? You paid it. So cinema owner, the theater owner, shifted that burden onto you but paid himself. So this is why we say the liability is on one person but can be shifted to another. Now, when we talk about non-tax revenues, there are a number of non-tax revenues also. The interest receipts. Sometimes there are some investments done by the government. So, interest received on those investments on loans are a part of non-tax revenues. Then profits, dividends, fees, there, I hope you very well know that ownership means you get dividend, and when it's just an investment, it means you get to have interest, right? Fees, you go and see Taj Mahal, right? So these fees, the entry fees and other fees, the government libraries and all. So if there is some fee levied, that is also part of non-tax revenue. The license fee, right? So all these permits, etc., when are made through government departments, so there is a minor fee levied. Fines and penalties, you jump a red light and pay the fine, and that fine goes to the government. It's objectionable. I'm simply giving you an example. Escheats. Escheat means the property on that claim where a person dies without any further family, right? There is no legal claimant for the same. So that property goes to the government and that becomes the non-tax revenue for the government. Gifts and grants also are there in the same category. And when we talk about the revenue expenditure, again, so revenue expenditure means those which do not create any asset or liability change for the government, right? So it neither creates any asset nor reduces the liability on from the government, right? These are reoccurring in nature, very usual for the routine functioning, general day-to-day activities of the government departments. So such expenditures are called revenue expenditure. For example, the salaries, the pension, interest payment on the government loans, subsidies. So all these examples are under the category of revenue expenditure. Mind you, once again, whenever we are talking about the term revenue, whether it is receipt or it is expenditure, it has nothing to do with assets and liability position. But at the same time, I recommend whenever you are defining it for one marker, you must give the direction of change. For example, revenue expenditure means neither creates asset. Means here you have to talk about asset creation and liability restriction, but it is not going to happen. Right. So you would say nothing of this happens. This is called revenue. No impact on asset and liability may reduce half a mark for you. Right. So the second component is the capital budget. Now, on the contrary of the revenue, we have the capital budget, which has the impact on the assets and liabilities of the government. Now, capital receipts, what are they? These create either a liability or cause a reduction in the asset. Think about this. You have a huge money coming to you, right? You always keep in your mind that when money comes, something goes and something is asset, right? So that's why we say reduction in asset. When money is coming, receipts are happening, so assets would be sold out. Or when money is coming, maybe I have borrowed from somebody, that's why money has come. So that would have resulted in liability to be risen. So you must give clearly the direction of assets and liability while defining capital receipts. These are of two types, debt creating and non-debt creating. What does this mean? For example, if I'm selling off my own asset, so the things are done, sorted, I've got my money. There is no further debt service, or I'm not required to do any further financial transaction thereon. Right. But in case of borrowings, what happens if I'm borrowing? If I have borrowed 100 rupees from somebody, maybe I'm required to give him 110. 10 is the interest factor, right? So this is an added debt created by the receipt of 100 rupees. That's why we say debt creating receipts, the best example is borrowings because we have to service the debts, right? But when we say non-debt creating, means, for example, recovery of loan, I had given my money to somebody and I have taken that money back again. So there is no financial repercussion now, right? Then disinvestment means I have sold out some of my investments or some assets. So this reduces my asset, but there is no further debt service involved. So again, small savings. So these also do not have any debt creating receipts. Okay, I hope this is clear. Now moving ahead, capital expenditure. So when we talk about capital expenditure means that type of expenditure which creates either the financial asset, means assets are risen, or causes a reduction in the liability. For example, I had a loan with me and I have repaid that loan. So money has gone, expenditure has happened, and that expenditure has resulted in the reduction of liability because loan was liability. On a very similar note, it goes for the government, right? So when we are talking about assets and liability, of course, these are non-recurring in nature and adds to the country's or economy's capital stock. For example, whenever the expenditure happens on acquiring the land, labor, building, machinery, equipment, so all these help to generate the capital stock of the nation. So this is capital expenditure and the repayment of borrowings, as I stated a little bit before. Fine. So now we are very much clear with the components of the budget. What do you mean by the term capital, the revenue, the expenditure, receipt, the nature, the examples? So we'll continue this session with the measures of government deficits in the next video. Till then, stay tuned and study hard. Bye bye. See ya.